The setup. A credit card is not your money. It's a short-term loan. Every time you swipe, the bank pays for you. Then you owe the bank. Simple. You're basically saying, spot me now, I'll pay you later. So when you buy a burger with your card, the bank buys the burger. You owe the bank for that burger. Cool, that part is obvious. Now here's where it gets interesting. The clock. After you spend money, a timer starts. This is called the grace period. It's usually around the few weeks. If you pay the full balance before that timer ends, you pay 0 interest. That's the clean version of credit cards. Use it, pay it off, no extra cost. But almost nobody stays perfectly clean forever, and the system is built around that. Interest. Interest is the price of borrowing money. If you don't pay your full balance, the bank charges you extra. That extra is calculated as a percentage of what you owe. This percentage is called the interest rate, and credit card interest rates are not friendly. They're usually much higher than things like car loans or mortgages. Why? Because credit cards are unsecured. That just means there's no asset backing it. You can't repossess a burger. So the bank takes more risk. They charge more. Fair enough. The trap. Some groceries, then a few online orders. Now you owe, say, a few hundred. Your statement comes in, and it gives you 2 options. Pay the full amount or pay the minimum payment. The minimum looks small, easy, chill. So you think, I'll just pay that for now. Minimum payments. Minimum is the smallest amount you can pay to stay in good standing. It is not designed to help you. It is designed to keep you in debt longer. When you only pay the minimum, most of your payment goes to interest. Very little goes to the actual balance. So your debt barely moves. It's like trying to empty a pool with a spoon while someone keeps adding water. Technically progress, realistically, not really. Compounding. Now we get into the sneaky part. Interest compounds. That means you don't just pay interest on what you spent, you pay interest on your interest. So if you carry a balance, month 1, interest added. Month 2, interest on the new higher amount. Month 3, even more. It stacks. Quietly. Consistently. Why banks love this? Banks don't make most of their money from people who pay in full. They make money from people who carry balances. Interest is the main revenue engine. But that's not the only one. There's more. Fees. If you miss a payment, late fee. If you go over your limit, sometimes a fee. If you withdraw cash, extra fees and immediate interest. They stack. Again, not random. Designed. Swipe fees. Every time you use your card, the business you're buying from pays a small fee to the card network and bank. So even if you never pay interest, the system still makes money off your spending. That's why cards are pushed everywhere. Apps, stores, online, subscriptions. They want you to use it. Rewards. Now we get to the part that makes people feel smart. Cash back, points, travel miles. Dude, I'm gaming the system. Relax. Rewards exist to encourage spending. You get a small percentage back, but only if you spend. So if rewards make you spend more than you normally would, you lose. Getting 2% back doesn't help if you spent 30% more than you needed. Credit score. Now the useful part. Using a credit card affects your credit score. This is basically a number that tells lenders how risky you are. Higher score, easier to get loans, better interest rates. Lower score, more expensive life. Credit cards help build the score, but only if you use them correctly. What affects your score? A few main things. Payment history, do you pay on time? Credit utilization, how much of your limit you use. Length of credit history, types of credit. The big ones, pay on time, don't max out your card. Simple. If your limit is $1,000 and you're constantly using $900, it looks risky, even if you pay it off. Utilization. This one matters more than people think. Credit utilization is how much you're using compared to your limit. Lower is better. Using a small portion signals control. Using most of it signals stress. So if you're always near the limit, your score can drop, even if you're technically paying the good way. Here's how to actually use a credit card without getting wrecked. Only spend what you already have. Pay the full balance every time. Pay on time. Always. Keep utilization low. That's it. No hacks, no tricks, just discipline. Used like this, a credit card is basically a payment tool plus credit builder, not a debt trap, the bad way. Here's how people mess it up. Treat it like extra money. Only pay minimums, ignore interest, stack multiple cards. Now you've got growing balances, rising interest, and stress, and it creeps up slowly. No explosion, just pressure building. Why it feels easy. Credit cards remove friction. No physical money, no immediate consequence. You don't feel the loss. Humans are bad at that. We respond to what's immediate, and credit cards delay the pain. So spending goes up. Not because you're dumb, because the system is designed that way. The psychology. There's a reason people spend more with cards than cash. With cash, you see it leave. With cards, it's abstract, numbers on a screen. Future you deals with it. Present you is just hungry and ordering another burger. Okay, so what? Credit cards are not evil. They're tools, very useful tools, but also very efficient traps if used wrong. The system isn't trying to ruin you. It's just designed to profit from common human behavior. Use the card like a debit card with a delay. If you wouldn't buy the burger with cash, don't swipe.